good morning to you all. A shakedown in the equity market worldwide. It starts in China, breezes over to Europe, and continues stateside. Futures on the S&P down 0.9%, on the NASDAQ 100.
All right. Good morning, everybody. Hope you all had a good weekend. There's a lot of things going on this morning that don't necessarily all come from the candles. So it's kind of a good idea to maybe take a look around. I posted in the large caps chat room a little bit of FX news. China devalued its currency this week. The last time it devalued this much was August of 2015. And it rocked the market like 7%. Hard and fast, the market sold off significantly. Something to keep your eye on today. I know that there's a lot of other things we got to focus on, and the Asian markets are closed already, but it reverberates, right? Like throwing a rock in the water and the ripples fan out. There's also the lockdown, which is exasperating, manufacturing and supply chains. There's still the war, obviously. I mean, there's a lot of things going on out there. Keep in mind, it's very often the things that we don't know about that topple a market. It's very rarely something that we are all focused on. It's very often something that comes at us from the side that we didn't see, that we weren't able to price in, that we weren't able to come to terms with. A lot of the biggest firms out there are now pointing to the downside, suggesting a significant break lower. I will continue to argue that we're really unlikely to rise back to our previous levels if we do not see capitulation first, right? Basically, if we don't see blood in the streets, if people don't throw in the towel and sell everything, freaking out, if we don't see that max pain, then we're very likely not going to reclaim previous levels. So we need a significant level of fear and breakdown. And we haven't seen that yet. Thursday and Friday, we did have a very, very high level of correlation in the market. Something I've been talking about now for over a week. Watch for correlation. Watch for correlation. It's going to be a signal. The most egregious moves we've ever seen in the market came when everything was moving in one direction at the same time, and there was nobody taking the other side of the trade, right? The old phrase about it's always easy to buy because there's always a willing seller, right? If you want to buy stocks, bonds, whatever it is, you can always find a willing seller. But if you're trying to sell and there's nobody there to take the other side of the trade, and you have to reach lower to find someone on the chain to find a willing buyer, and nobody's buying, that's where you can see prices fall very, very far, very fast. Right now, we're looking at Bloomberg, 5 things you need to know. It's a free publication. Even if you don't have a Bloomberg subscription, you can go over there and sign up for this newsletter. They'll email it to you, which is pretty cool. Take something like that and add it with what FX Street provides for free, and you have a pretty decent idea of what's going on out there on a day-to-day basis with forward-looking perspectives, right? Because you can kind of look ahead on the day and say, what's coming my way today that I need to be aware of? And it's not always our news, right? We got Canada, and then we've got the European Central Union. And those markets also have news that can affect us, right? I like to just take a look around over there. You know, a lot of times it's not going to tell me something I didn't already uh, hear about, but you never know. It's worth taking a peek, especially since it's free. So the stock 600 was down quite a bit, and it was driven by oil. Let's see, I had the FX Street, or excuse me, Finance Juice, Europe Market Wrap. That's on Financial Juice, and it's free. This will basically give you a summary of what's going on over in Europe right now, right? Because they've been open since, oh, I don't know, like 3 o'clock this morning. At the end of our day, they'll also have a US market wrap, right? It's kind of nice. You only see the Discord screen. Let's try that screen. Thank you, Regina. Not sure what oh, you know, we had power outages last week, and I think maybe the Zoom got confused about what screen number 1 is and screen number 2 and screen number 3. So now you guys should be seeing Financial Juice. All good? Orderly. I guess it's all good then. Thank you for the heads up. Yep, Zoom just must have got a little crooked. So this little market wrap comes out in the evening after our market closes. It comes out after Asia closes and after Europe closes. It's a nice little recap on the day, and it's another free source, right? So, you know, I hang out on Finance Juice all day long because when there's something impactful that shows up, it usually brings it to us in a bright red box. It's real easy to see. Absolutely love that. It looks like this. Can't miss it. So um, I am signed in, but I'm on the free version, right? You don't have to pay for this. I would recommend, though, hitting the gear icon and adjusting it so you can weed out things you don't want to see, like MSNBC posts and, you know, junk like that. But it's a nice little heads up on the day. Get an idea of what's going on over in Europe. Miners and energy companies led the way down in Europe in the overnight hours. And then Morgan Stanley came out with a pretty blunt message to their investors that they see significant downside in the S&P. Take that with a grain of salt, right? It's like I've been saying, the more people that look down and the more people that say we're going down, the more I start looking up. There are a lot of companies reporting this week, including most of the FANGs are going to report this week. It's a really big deal. Having some perspective, some of the biggest names have already fallen more than, say, 30 to 40% off of their highs. If you go and look at, say, a 2-year chart of Netflix or PayPal, Spotify, Zoom, look at how these companies have just been completely beat down. And then kind of ask that follow-up question, which ones have not yet participated in such a significant sell-off? Google, Amazon, Netflix, or Nvidia. So there are some names out there that have not yet tumbled as much as its peers. We got to get that max pain. We have to see that capitulation. All right, we got 8:30, 10:30, 11:30. Those are where the additional economics are today. The 11:30 is going to land right in our lunchtime. It's usually that time of day where we don't expect any sort of trend or breakout that sticks. But on a day like this, when we have those additional auctions at 11:30, this is one of those rare occasions where a breakout during lunch can become the game changer on the day, right? I've seen it so many times where, say, we were bullish all morning, things are looking really good, we top out into lunchtime, the 11:30 auction comes out and just flips the market over, kills the trend, dumps us to the downside, or just stalls us out, and we quit advancing. Or same thing in reverse, that we were down on the day, we built a base along those lows, 11:30 hits with these additional auctions, and we spike up off those lows and reciprocate back towards where we opened. So don't discount the clock. Keep your eye on 11:30. Additional auctions have the capacity to completely reshift our market, right? It can take us from bearish to bullish or vice versa, and it can just straight up kill a trend day. So if we already were trending and doing really good, this can just wipe that out and stick us sideways for the rest of the day. So we're on a daily chart, kind of zoomed in a little bit. We're looking at the weekly expected move, and we're looking at an anchored VWAP. The anchor starts basically at the first of the year. Wait, make sure it actually does just run back to the first of the year. That way, you always got to be careful with anchor swim. The indicators can get a little wonky if you don't give it exactly what it's supposed to have. So the chart is set to year to date. The anchor starts on the very first trading day of the year. That was January 3. And you can see that we are below the average on the year. The box this week is much bigger than the box last week. Right? Maybe it's easier to see it the other way around. This is the size of last week's expected move, and that's how it compares to this week's expected move. Volatility is up significantly. Surprise. There is some concern that if we revisit the 4100, that it's likely to fail here. The ES doesn't have as clean of a bottom as, say, the SPX or SPY, even though it's all the S&P 500. It's just different perspectives on it. But it's still a very weak low, and we want to be cautious here as we come down into that 4100. The idea across the board from all of the major analysts out there suggests that if we do retest 4100, it's very likely to fail. Persistence beats resistance. That's one phrase that I like to use. But liquidity, right? If there's nothing left down there and we keep absorbing all of that liquidity until there's nothing left, we're going to break below that and go lower on the hunt for liquidity. There is an angled support at 4,200, so it's worth noting that it's there. Wouldn't expect it to be anything like a handrail. I wouldn't lean on it. So we're looking at mid-January all the way up. And the range is, I think, is pretty clear. We're right now, we're just traveling back through where we've already been this year. I've heard the phrase, we've seen this movie before. So that kind of fits, right? Um, it wasn't the idea of where we were going, it was the speed at which we moved in that direction, right? That's what really seemed to have gotten everybody concerned. We were mostly inside of the range, right? We used the SPX for this discussion just since we've already got the lines there. So you could see for the most part, we were already there. It wasn't the issue that we moved too far too fast. That's last week's range, and everything going from the highest point to the lowest point in a single day. That was a little bit of a significance, but at still, we just barely peaked out the top, and we just barely peaked out the bottom last week. You could say we were basically saved by the bell, though, because those hedge trades end at the end of the week. So if that breach had happened, say, on a Tuesday to the downside, and the algos kick in and sell into selling, which is what they do, it could have drove us to some serious lows. But the the bell rang. We were at the end of the week, and it was a done deal. Got an ADR of 1.7, and we're only down 0.8. So we still have 1% that we could travel today that would not even be considered outsized in its move, right? It would need to move more than 1.8% today to be considered an outsized move. Mapping that out, if we were just to add 1% to our current location, it gets us right around that angled line. So it's always nice to see when your technical analysis lines up, right? To be able to see confluence with what it is that you previously drew somewhere else, matching with a current assessment of market activity. So the ADR would put us at that angular line that I drew moments ago, right? This line here. So we want to game that out. Three different ideas. We could stay range bound, we could break to new lows, or we could begin to reciprocate back up through the previous levels. Now, interesting enough, linear regression and mean reversion would state that after a move like Thursday and Friday, we should be seeing moves to the upside, and we're not. That says a lot. It's not just the idea that we don't have those technicals on the chart. It's the idea that it's like nature. It's like gravity. There's really not a lot of alternatives when you see a market that's moved that far, that fast. The expectation is kind of the same expectation you get when you throw something in the air. You expect it to come back down again. It's that normal, or is that well understood, and yet we don't have it this morning. So it almost fits into when what should happen doesn't happen. So if this move to the downside continues, I think that the ADR is going to be the least of our worries, but that would put us down below 4,200. And if we were to game out an even more significant move to the downside than that, we want to give it like an aw damn moment, right? If 1.7 is normal, then double that. Get a 3% move on the day. Well, we're already down 0.8, so we'll add 2.2, and that puts us right around 4150. It's close enough, solid number. So we're going to just mark out that 4150 and say that that would be the downside if things continue to look as nasty as it did on Thursday and Friday. So if that's the downside scenario, then what would be the mid case? Mid case, or just maintaining the middle, would be our own Globex. That's a real tight range in the current market conditions. So while it's absolutely possible, I don't believe it, right? I would take that off the table and I would instead extend that range all the way up to encompass Friday's Globex high and today's Globex low. That would put us at 4,400 flat. And I mean, we're close enough to it. I would make it 4,200 flat, right? That's a $200 range, 200 points. And it would line up. If we do stick with just the Globex low, it's 42.16. So 4,400 to 42.16. If we're going to stay range bound, that's the range that I would call. On that upside move, we have the Globex open. It's an institutional pivot point. Very likely to see a reaction when we get there. We have Friday's low. Those two are close enough together that you could consider them a zone. We have a natural pivot point around 4,300. We have the Globex low from last Friday at 4,360, the open at 4,380, and then 4,400, which is that little hurrah before the open Friday and before the dump. So that gives us some key points on the way up. There's a cog line at 43.11. So we're looking at a volume profile here. It's a 30-minute, 10-day profile. And you can see that we have a very, very tight range. The box is very narrow. Most of the volume is sitting between 44.78 and 43.80. Now this is volume, so this has already happened, right? This is old stuff. We're looking back and saying, where was the transactions? 70% of all of the transactions happened inside of that box. We're in the shallow area. There's really nothing here to restrict us. And although there is a little bit of a bump around that 4,300 area, I just don't see it as being significant enough to do anything. Another thing I'll point out is we are not just outside of the box, but we are significantly outside of the box, right? We are a long ways away from that box, and the box is very, very narrow and very far away. Generally speaking, this goes back to what I said just a few minutes ago when things do something that they're not supposed to do. When we're outside of the box, generally speaking, we expect price to go back into the box. We expect to see it moving in that direction at the very least, and we are not yet moving in that direction. We're kind of paused and consolidated here at the lows, so we're no longer moving away from it at the moment, but we're not moving back towards it. If we retest 42.70 and fail there, I don't think that we will reclaim the box today. I think we'll end up maintaining that range and or breaking down lower. There is a volume profile point of control from Friday at 43.35. It's just worth noting where it is. I don't see us getting up there. So it's almost two different perspectives, right? On the one hand, after having fallen so far Thursday and Friday, we expect price to go up today just from mean reversion alone. On the other hand, there's absolutely no signal out there right now that says we're going to the upside and that this downward move is not yet done. So one side says we're supposed to be going up now simply from mean reversion, while the other side says we're not done selling. Take a look at the NASDAQ. Year to date weekly chart, we're underneath the volume, the anchored volume average weighted price, the VWAP. We have that low that we were talking about in the S&P, only it's a little cleaner. This one's at 13,000. Take a look at the size of the box in the NASDAQ compared to last week. So this is the weekly expected move. And this is the new week's expected move. We can see that this week's is bigger, but not significantly bigger like it was on the ES. Again, it's worth pointing out what price did last week because it's kind of a rare thing. I say it's rare, and yet I can see numerous examples that I'm about to point out. We went from the highest point to the lowest point in a 24-hour period, right? On Tuesday, we opened, touched the line, fell all day, and then on Wednesday, we completed the move and got to the bottom by the end of the day. And the same thing happened last week. Thursday, we hit the edge on the top side, and by Friday, we were breaking through the bottom on the downside. That's a rare thing. I know it seems like it's kind of common because I'm able to point it out in multiple places, but I'm only able to point it out in multiple places because of the level of violence right now, right? That's how much extreme movement we have going on in the market, that this very rare thing is happening week after week after week after week. It's been absolutely nuts out there, and there's been a two-sided marketplace, right? There's one side where everybody still says, oh yeah, energy's good, and there's some retail that's doing okay, and there's selective sectors that are still okay, and then there's everything else. Well, on Thursday and Friday last week, there was nowhere else. Everything was down, right? Like everything. Total correlation across the board. Every single name in the index was headed to the downside. All the sectors closed red. There was no safe haven. All right, so we're looking at the NASDAQ on the bigger picture, just kind of stepping back a little bit to see where we're at. That 1300 that we were talking about, that's a significant level. And should we break that to the downside, I think that's going to be the start of the max pain that we were talking about. Sorry, I seen FX come out. Thought I seen some movement over there. So for today, the same approach as we do on any other market. We can do three things. We can break to new lows, we can maintain the range, or we can break out of the top of the range and continue the move to the upside. I see the range as 13,800 for the top of the box and our own Globex low for the bottom of the box. That'd be 13,200. So nearly a 600 point range if we were to call this a range day. The good thing is there are some pivot points along the way, like signposts. Right. So we had the close of Friday. We have our own Globex high. Those two are close enough together that you could count them as one. We have a very tight initial balance, which is almost a promise or a guarantee or a hint or a suggestion that there is still a lot of work that needs to be done. Think about it from the perspective of someone who has a job, right? And their job is to pick up or unload X amount of contracts per day. So they get the call, the boss says, hey, I need you to grab X amount of contracts. If they do a lot of that trading early in the Globex, then you see the move in the Globex, right? Our initial balance or our first hour in the Globex is a wide range with a lot of price action that moved in one direction or another. If they got the call and says, I need you to move X amount of contracts today, and there still has not been a very much movement, then you can kind of look at that as she hasn't done her job yet. She hasn't gone out there and bought what she's supposed to buy. So she's going to wait. I don't know what she's waiting on, but whatever it is that she's supposed to pick up has not been picked up or unloaded or dropped off or whatever, right? No transactions of significance have been accomplished yet. That's not my perspective, by the way. If you were to go and say, do a little bit of search on what initial balance is, who invented it, what their discussion is on how to use it on a day-to-day basis, that's exactly the way that they approach it, right? It's the way that they bring in the discussion on what is initial balance and why do we look at it. It shows a lack of completion. So another pivot point to focus on would be 13.5. Then we have the open on Friday and then Friday's high. We will also want to check to see if there is a point of control up there. And we can see the point of control is very close to 13.7. So you could mark the open, or you could just carry that point of control. I think I'd rather focus on the point of control. They're so close together, it wouldn't matter, right? It'd be either one. And 13.6 is basically the Globex low. So I'm going to take that one. So as you can see, when we look to the upside, there are significant levels that we can point to. It's a lot of them. One thing, somebody said something once, and it bothered me for a long time before I was able to start to get past it. It was kind of a off the cuff, snide comment. Said something like, well, yeah, if you draw enough lines, price is bound to hit one of them. And that really stuck with me for a long time. It seemed like it, it made me hesitant to draw lines, thinking that I was just randomly drawing crap on the chart, and that you're right. If you draw enough of them, price is bound to hit one of them. You want to kind of prove those lines. You want to have some reason behind why you're drawing those lines, not just being able to connect wicks or connect the bodies or the wicks and the bodies. It's actually having something to point to with some history and validity behind it, which is why we go in and we look at something like the volume profile, being able to make sure that our lines match up with high areas of volume, maybe even the point of control, that we have something more than just a place where price pivoted and moved in the other direction. We got an ADR of 2.7 right now, and we're down nearly 1%. So first we want to mark out that regular move. If we were just to hold the ADR, that would put us right below that 13,000 level. So we'll keep the 13,000 for today's ADR. But just like we did in the ES, let's go extreme. If 2.7 is a normal average day right now, what would an extreme day look like? Let's double the ADR and kind of lean it into a round number at the same time. A 5% move to the downside in the NASDAQ. And if you're thinking, yeah, right, I mean, that's really kind of extreme. We've done it before. We can certainly do it again. So we want to add 4.2 because we're already down, 0.8. Really, we're close to 0.9. So we'll add 4.1 to this move to the downside. And that would put us at 12,700. So that would be our extreme case today. Remember that the lock limits on futures actually calculate based on where we were around 3 o'clock the day before. So it's something to keep in mind. If we start moving that far, then the discussion of lock limits is going to come up again. So that gives us our range analysis, downside analysis. Let's do the same thing to the upside. If we were to get above yesterday's highest value, is there anything left? Well, that would be a 5% move all on its own, right? From our current location. That'd be a 4.25% move from our current location. So we could add a little bit more on top of that and give it the full 5% move. Reclaiming 0.87. There's a 5% move from our current location. That gets us pretty close to 14. And that lines us up with some significant pivot points. If we get a day like that, guys, it won't be subtle. It would take just a massive move in the market. Really good news would have to come out. And I mean, really good news. It would be on every radar, tick, trend, AD, everything would be lit up, right? There would be nothing subtle about a significant move to the upside to get us back to 14. I don't see that happening, by the way. But if we did the work on the downside, we also want to do the same kind of move to the upside and just in our measurement and analysis. The two most likely scenarios are that either we break to the lows and make a continuation from Thursday and Friday, or that we mean revert and we in some way maintain Friday's price action. That is the most likely scenario today, by the way, right? Especially after those two big moves to the downside Thursday and Friday. Going lower from here would defy most technical analysis actions. All right. Tasty Trades used to go around the United States and they would teach what they call the aggressive contrarian trade strategy. They taught it at webinars and seminars all over the United States. And basically, the whole idea of the trade setup is, oh, wow, we've just moved really far in one direction really fast. Take the other side of the trade because price mean reverts, right? It's what it does. Well, that might be what it does, but it hasn't done it yet. All right, so we did finally decouple from stocks and bonds. You can see that the bonds are sitting up near the high of their Globex range. Test, and testing yet again. We are just at the point where these are about to open up. And if it cannot break through this level and the buyers give up and we start to see a dump here, we could actually begin to see a move to the upside in the S&P and in the NASDAQ. The good thing, though, is that they finally decoupled. Remember, a lot of times last week we kept saying stocks and bonds are moving in the same direction. That fits into that same discussion where we continue to say that things are doing what they're not supposed to do, right? Or something that should happen isn't happening. And that throws everything off. At least this morning, things that should be happening are happening, right? When bonds are up, stocks are down. That's a little more normal. We had that double top in the dollar. Be very cautious of this as we come into the open. These two are the drivers right now. The pain in the bonds has been way more significant than the pain in stock, right? And the move to the downside in bonds has been so far and so deep and so long lasting that we're just starting to see that rebound, right? It's that linear regression, a mean reversion that I was just talking about. We kept waiting to see those bonds pop back up, and they just kept going lower and lower and lower and lower. Well, they're finally popping up. It could be a dead cat bounce for all we know, right? It's not like we are suddenly looking to see bonds make exaggerated moves to the upside for any other reason than how far they fell. So they are bumped up at the moment. If they can't make it through their own Globex level and begin to dump, then we could very well see the S&P and the NASDAQ pop up. But I'm going to caution you now, pounding the table and saying it more than once. We correlated last week with stocks and bonds both moving in the same direction at the same time. If this starts to sell off this morning and stocks go with it, buckle up. We're going to hit those lows in the S&P and the NASDAQ that we were talking about, right? If these two recouple and are both moving to the downside at the same time, it's going to be Thursday and Friday all over again, but more. Goldman Sachs and JP Morgan already started using the R word. Redemptions are being called. It's just a trickle at the moment, but if we see a continuation in redemptions, that's going to exasperate the situation even worse, right? It's going to blow it all out of proportions. It's a little odd to see the dollar selling off at the moment here, this little micro double top. It doesn't fit with the rest of the scenario, and it almost leans into already first thing this morning looking at something and saying, you know, it's doing what it shouldn't be doing. I'm of two minds at the moment. One side says I should agree with every analyst out there. They've been doing this for 20 years. I've only been doing this for 3. Every analyst out there says short it, short it, short it, short it. Go to the lows. We're headed down. Sell like crazy. I don't agree with it. Every instinct in me says they're wrong. There's going to be a max pain level, that we are going to go down, that there is a max pain level, but it's not a long-term downward move. And I'm not the only one that's been saying that, but there's literally 2 camps right now. One side says we're going down like we've never gone down before, and the other side says, oh, we're going to hit some max pain and flip over and go back up again. Rather than sit out, since that seems to leave us stuck on the fence, I'll continue to promote the idea that you can do both, right? That you can be long and you can be short. Buy a put, excuse me, buy a put, and if the market starts to go up, sell puts against it. You can make money on that put, right? That put is your collateral, right? It's your leverage. So if you buy a put in Apple and Apple rebounds here and continues to go up and breaks 180 and just runs to the freaking moon, so what? Sell puts against it. Right? Same thing with calls. If you're bullish, go out and buy some calls. Give yourself 3 months, right? Buy calls for September, October, December, January. And if you're wrong and we don't rally up and those calls aren't working, they're your collateral. Use those to sell calls. This gives you a chance to participate in the market and not have to worry about that dichotomy or that binary market state that says we win or lose. And when every single channel says sell, that's usually where I'm buying, right? But that mentality works most of the time, right? But when it doesn't, because nothing works all the time, when it doesn't, then it's like COVID all over again. But by just straight up buying calls and puts, by not using a spread to start the trade, you actually give yourself some tools, right? You have an avenue of escape rather than just taking the pain. The discussion kind of goes like this. When you open up a vertical spread, like like a debit spread or a credit spread. Tasty Trades promotes this idea that you should manage your winners and let your losers just sit there. Like, let them go, forget it. And their reasoning behind that is there's not a whole lot of things that you can do to a vertical if it's not working. I don't necessarily agree with that part of their statement, but I mean, for the most part, they're right. If you put on a vertical and it's not working, there's not a lot you can do about it, especially if you were using things like out of the money spreads. And so their argument is, well, to manage our money, we'll just build the trades small enough that we're comfortable with the pain that it's going to give us if we're wrong. And we only manage winners. Now, that's not my style, right? That's their style. I'm just sharing that. Tom Sosnoff is one of the smartest people I've ever come across in my entire life. And when it comes to options and trading, I mean, he sets a pretty high bar for, everything. And that's his logic. That's his philosophy. Build it small, build it frequently, throw it out there. And if it's losing, shrug and move on and let the loser sit there. Who knows? It may come back. It's already lost. There's no reason to close the loser. That's his approach. Well, in a market like this, where everything is losing constantly because we're going up and then down and then up and then down and we're up and we're down, there's no consistency or follow through to any of these trades, then those verticals are going to just shred your account, right? It's going to be continuously nonstop, just taking punishment in those verticals because they can't be defended very well. Your only defense is to shrug and say, well, hopefully it'll come back around. I'll just leave it on. Forget that. This isn't the environment for that. Just straight up buying calls and puts with enough time to be able to sell against them. This is the market for that. Except that there's the other side of the argument, implied volatility. When you buy a call and the volatility is really high and the market starts to rip to the upside, proving your call right, your call is going to get stripped of that value from the volatility crush. So that sucks. And that's why most of the time we like trading verticals so that we can shunt that volatility crush. Well, right now, what's your choice? You got two choices. Put the vertical on and continue to suffer when those don't work because you're trying to protect yourself from a volatility crush, or just straight up buy the call, take the crush, and still see profit on the other side of it. And while you're at it, if the market doesn't do what you expected it to do, like go up, then you can sell calls against it. And the selling the calls or selling the puts would be a focus of day to day, week to week, right? Every other week, you're working it off. So, for an example, I have some Apple calls for the 180 strike. I've got 6 of those calls. They've obviously been losing for a while now. Apple is not at 180. It's not anywhere close to 180. And those calls were expensive. I've had them for quite a while. So you can imagine if they are, uh, if they're $8 now, imagine what they were when I bought them months ago. They were a lot more expensive than this. If you were just to look at those calls, you would see that my P&L is down significantly. But I've already made that money back. Those calls are mine. They're free and clear. They have no loss left in them because I've already earned all of that money back by selling calls in front of it. And I've still got them. I've got them for months. September, October, November. So it doesn't matter now to me if those calls ever work or not. They're still collateral. I can still sell against them and make even more money. And it does not matter to me at all that those calls are losing. I made my money back. So focus on your swing trades on names that you're bullish on or bearish. I mean, this works both ways. You could take the put side too. Take something like SPY. Everybody keeps telling me I need a hedge. I need a hedge. I need a hedge. Fine. Buy a SPY put. Buy a put 90 days out, 100 days out, whatever. That's going to cost you about $2,000. If SPY rallies, that put that you have is going to lose. But You have a put. That's collateral. You can then sell puts all the way back up. You can sell puts and pay off that put that you have, and that gives you a free hedge because now you're holding a put for free. It can be rolled, adjusted, managed, and you can continue to sell puts against it long after you've already made your money back. You're carrying a free hedge. You can do that in everything out there, right? We're using XLF right now for our hedge. Got a risk twist spread on in this thing. Well, this is a much, much cheaper market, right? You could go in and just straight up buy puts in here in double digits, 10, 12, 15 of these things, so that you can spread out your lots on the sell side if we happen to rally back up so you don't put them all in one spot. So, so guys, that's what I've been doing through most of this year is just, and I'm the spread guy, right? I'm the guy that's usually always telling everybody, put on a spread, don't buy calls, don't buy puts. I can play you video after video where I've said those words repeatedly through 2019, 2020, 2021. I'm the one beating the drum and saying, why are you not using spreads? You need to use spreads. Well, now it's the other way around. And it's not because I'm suddenly a big fan of calls and puts as a naked leg trade. It's the idea that those can be defended and the others can't. When we get back into a more normal marketplace, I will be happy to go back to trading verticals. I've also been doing a lot of butterflies recently, mainly from the idea that a butterfly is a very, very, very low pop trade. It has like a snowball's chance in hell of being a winner, but it risks 2 pennies, 3 pennies. And the levels that we're using, when you're looking at a chart and you identify a pivot point and you throw a trade on that says, if I'm right and we hit that pivot and stick there on Friday, my $2 is suddenly going to make $50, $75. Yeah. Hey, it won't make a mortgage payment, but I risked $2 to make $50. Yes, please undo that. I like that. All right. So we can participate. We got a lot of earnings this week. Keep the butterfly in mind for those earnings. I know it's a low probability trade, but they're very, very cheap. They sustain volatility crush really well. So a butterfly does not take pain from the volatility crush. And it allows you to participate in just about any market relatively cheap. I had butterflies on for Tesla and it was $60. Now, granted, I had more than one on and I put them on days before Tesla actually reported. And no, they didn't work. They both lost. But I rolled the short legs closer in and I was able to get my money back, get my $60 back. So even something as expensive as Tesla, I was still able to find a cheap way to participate in the earnings. And it didn't matter that it didn't work. I got my money back and, I didn't get a real good payout, but I didn't get hurt. Right. So, lots of names on the earnings schedule this week. Give butterflies a chance. Kind of look them over. Consider the outcome of that. Keep in mind that market maker move combines with the expected move for that earnings, right? But old school, this is the way they used to calculate how far could a market go for earnings because we didn't have all those fancy tools back in the day, right? The way they used to measure how far a market could move for earnings is they would build an at the money strangle, right? Or straddle. So we got the 162.5 and the 162.5, and they would look at that price and they would say, okay, well, Apple can move, 9.25 higher from here or 9.25 lower from here at its earnings move, right? Now it's old school way of doing things. We don't have to do it that way anymore. If you notice when you go to the earnings tab, what do they talk about? At the money straddle. What is that? It's literally just what I showed you, right? They are measuring that straddle before its earnings announcement, and they're saying, how far could this move for earnings? And then they look at the outcome. How much did it move in earnings? It's right on the Thinkorswim platform at the Money Straddle. Now, we got something a little more modern than that. We've got the market maker move, and then we have the expected move. Well, you can add those two things together, right? So Apple doesn't just have a $9.58 move for earnings projected. It has 958 plus 770. When you put those together, that's the scope and the size that Apple could move, and it wouldn't even be considered significant or outsized, right? If you see Apple make a $16 move on its earnings report, that wouldn't even be considered a big move because it was already measured and gauged. It would have to move more than $17 before we would look at it and say, wow, Apple moved a long ways. Now, I used to build iron condors with this. I don't do that anymore, mainly because the iron condors are so far away from price that there's literally no profit in them. And the risk that you get ran over is still there because you can never get far enough away, right? So while it makes sense to measure the range of an earnings and say, oh, well, yeah, $16 to the upside, $16 to the downside, and then we just build our iron outside of that. That's what we used to do. I don't do that anymore. There's not enough money in it. The profit sucks and the risk sucks even more. So now I've just been building butterflies where I think the max pain is or the edges of those expected moves. I've been putting butterflies on there. Sometimes I fill them things for a penny or 2 pennies, depending on the market. Like Amazon doesn't have single penny trades, right? You got to go, and Amazon, it's got to be like a nickel or a dime size. But still, putting them on really, really cheap. And if they don't work, just shrug and walk away. Like, who cares? Even with Tesla, it was $60. I wasn't going to walk away from $60. I wanted my money back. So I got my money back. It took a significant level of buying power to do it, but I got my money back. So something to consider for the week. Butterflies on those expected move edges. If you're wanting to continue to swing trade, focus on just straight up buying calls and puts and then selling against them. Think about using those puts as a hedge, just straight up buying the Qs or SPY or IWM or, the sectors, XLI, XLF. Buy puts in those things. And if it doesn't work, or if the market starts to rally up out, great. Sell puts, make your money back, that you can cover that. So I got for you guys. Be careful, be safe. I'll see you all tomorrow.